We should be live on all three. All right, we are live giving our reactions to earnings. This is one of the biggest days of the year. There's sort of a handful of days, usually on Tuesdays and Thursdays during earnings season. And this is one where Jason Hall and I were talking about some of the companies that are reporting today, and there's some big names. So, Jason, what's your
Disney,
what's your early
Axon,
reaction here today?
Enterprise, Plug Power, Lemonade, maybe the company I've been most looking forward to. Upstart's reporting. There's a ton more. I mean, there really are, but I think we're going to focus. Really, we're going to focus on. We're going to start off with Upstart. They've already dropped their earnings. We have it. Disney has dropped their earnings. We have that.
Yep.
And then Axon and Lemonade, based on when we get the reports. I think Lemonade's earnings call is not till tomorrow morning.
Correct.
So they may not drop their call, their press release till 4:30 or so. Travis, you ready for me to get things going here with Upstart?
Yeah, I want to frame this. Just give me the 20-second overview on what are we looking for? What are the metrics in an Upstart earnings report that you're looking at to see is the business doing well or not?
So a starting point, what is Upstart? So Upstart is not a lender. They are a lending platform where loans get originated. Now, they have originated loans that they've kept on their balance sheet to sell after the fact, but generally the bulk of their loans that get originated are done with a lending partner, a bank or a credit union, or a consumer finance company that is a lender, right? So that's what their business is. The hook, the mousetrap, they're saying that their better mousetrap is they've used AI, and we've got some former Googlers that have built the company that point out that this reality that there are a lot of people that are kind of left on the outside looking in with the modern credit system, the way that it's built. And they think that there are a tremendous number of credit worthy people that the current FICO system deems as unworthy in terms of the level of credit risk. And they're saying they have a better product. So that's kind of where we're starting from there. Travis.
That's the thesis. Yep.
That's the thesis, right? And here's what we don't know. We don't know if that's completely true. We have seen some evidence that the loan performance from some of the partners that are giving us the data has been good, but we haven't really seen it through a full economic cycle. Okay. And this is really, really important because the core business, the loans that are originated on the platform right now, the bulk of them are unsecured consumer loans. In other words, you have credit card debt that you want to consolidate, or a student loan, and you want to consolidate that debt and try and get a lower interest payment. It's a consumer loan that you get. Here's the thing, Travis. It's not, there's not an asset that backs it. There's no collateral.
There's nothing to seize. There's no house. There's no car.
Right.
Yeah.
So what that means is that this is the kind of debt that is at the leading edge of the risk when defaults start to happen when we go into like a weak economy, if we actually go into true recession, right? So the challenge with understanding Upstart at this point is, since the company was born, we haven't had an economic downturn, like a full recession. Again, we went through the pandemic, right? But there was a massive amount of government aid that flowed in, and people had plenty of money, and a lot of people still have money coming out of that.
Savings rates actually went up, which is really unusual during a recession.
Totally, yeah. So we haven't gone through like a normal, recession where we're going to find out about the performance of its loans and whether the product that they've built and the AI that looks at these other metrics is right, and whether those loans are going to perform better. We're not going to find that out now. So you're starting to pull up some of the numbers there, Travis, and I'll go through it and I'll hit it. And here's the thing. We expected a lot of this. Revenue down 31% in the third quarter. Fees-based revenue down 15%. Again, we expected that, right? We've already seen on November 1st, the company filed an SEC filing that they had fired 140 employees. Travis, those employees process loan applications, right?
Yeah.
So you're terminating revenue building employee people that actually handle the thing that drives your revenue, right? So it's not a surprise. We also know that a lot of their lending partners have kind of pulled back from the platform a little bit. Banks are getting really risk averse right now. So we knew that was going to happen. So now here's some big things that are important. The big thing is that, again, as we started to see in the prior quarter, shifting to a loss, operating loss of $58 million,
Yep.
down from an operating profit of almost 29 million a year ago. GAAP net income, GAAP net loss, $56 million, again, from profitable year over year period. I'm gonna slide down a little bit further. I'm going to skip the outlook and we're going to come back up to that. And what I wanted to look at is I want to talk about statement of cash flows. Okay.
We'll
So we get down to that. And that is on page 5 and 6. It's kind of cut in half.
There we go.
So if we go down to page 6, you'll see net cash provided by operating activities. So here's the thing. On the left is last year. The right is this year. And you see, this is the big thing, right? Because there's that net loss, and then there's how much cash you burned to support your operations, and burned through $421 million, right? So that's substantial, right? So that's really important. I want to go back up to the balance sheet next, because when you're burning through cash, you kind of need to know how much cash, how many assets do you have to get you through this. So cash and restricted cash, you're looking at around 800 million, right? So that number is starting to come down. Now, one thing that you see that has ballooned is loans held at fair value, right? That's $700 million. That's a big $500 million increase. We've already seen the market freak out in the past when the company ended the quarter with a large amount of loans on its book. Again, that's not the company's core business. They don't want to become a lender, right? Because that changes all the rules. The regulatory regime is very different. So they don't want to be primarily in the lending business, right? They want to be the platform where loans get originated. They make money on fees and services, and then somebody else takes it off, and then they go make money on the interest, and then they take on the risk of the loan defaulting, right? So it's going to be interesting to hear what management says about that very large number. And how the market reacts to it. Here's the risk of that number. Okay, Travis, this is, I think, is really, really important. If the company doesn't already have an agreement in place with a lending partner to acquire those loans, and it could, and they're just going to carry over the quarter, and they're going to be acquired, and some are going to come off the books, after the quarter ended. And again, management's going to give us some information about that on the earnings call. But here's the risk, Travis. If their loans do not perform, and it has to hold loans longer than it wants to, and the loans and the performance of those loans deteriorate more than the company has projected that they would, and all of the data that they provided to the market and to their customers and potential customers, the value of those loans is going to take a hit, right?
Yep.
So that's a risk, right? The other thing too is, frankly, if we just do go into a deeper recession than expected, that alone, even if the loans perform reasonably well, could affect the value of the loans, particularly if interest rates keep moving higher, right? Because every time interest rates move higher, existing debt that was originated in a lower interest rate regime is less valuable, right? So there are a lot of pressures that could affect the value of all of the assets they have, besides cash, obviously. But that particular asset, we don't know what it's actually going to be worth to the company. And at the rate that it's burning through cash, again, $420 million in cash burn just in this past quarter. So I think that's a really, really important thing to think about with Upstart. Is you can exit the screen share here, Travis.
Yeah.
The way I'm thinking about Upstart right now is this is kind of its crucible moment. It's about to go through the crucible and prove out whether it's a high quality metal and we're going to get something amazing after it gets, born in fire, or is it going to burn up, right? And there's a little bit more to it too, because it doesn't control a lot of its future, because it does rely on a pretty concentrated group of lending partners for the bulk of the loans that get originated. There's the risk that it's just its fixed costs versus the revenues that it's bringing in. It's just going to burn through a ton of capital before we get clear of this. And that could be very detrimental to shareholders. So I think it's an interesting risk reward investment for investors that two things. Number one, can risk capital, they can get incinerated and they can move on with their lives and it doesn't affect their lives at all. It's okay. They can actually lose that money. Number one. And number two, investors that can deal with the volatility of what could happen over the next year or two with the company.
So many questions with this company. That's what I think I really have a hard time wrapping my head around. And I'm familiar enough with the banking business and how loans work to be dangerous, but this isn't my specialty. But you get to a company like this and it just seems so volatile. And like you said, we haven't been through a down cycle. I mean, this is sort of the wild thing is that right now through, let's say, middle of next year, maybe into next year, is going to be probably the first real normal recession that a lot of these big name public companies who became public since, let's say, 2010
Yeah.
have ever been through.
Right. Right.
And not to mention, not only that, the recession piece of it, but it's the first time that any of those companies have been in a rising interest rate environment.
Yeah. So you think about a company like this, right, with their cash
Right.
burn, living off their balance sheet, and they generated a tremendous amount of profit for about a year there. And then everything that's happened and the lenders have gotten very risk averse. So no, you're exactly right. So we're seeing in real time, that's what's happening with Upstart. I want to point out a couple of positives real quick, Travis.
Okay.
They continue to add banks and credit unions to their platform. Okay. They've more than doubled it. A year ago, they had like 35 or so. Now they've got 83. So that's really, really good. The problem is, again, look at the loan volume, look at their revenue, look at the fact that they cut loose 140 people whose jobs are to process. And it's not like they said, oh, we've come up with a new AI tool that we don't need these people to do it anymore. It's no, it's the macroeconomic condition. We have to reduce staffing. We have to make this move, right? So there's a little bit of positive, but there's the reality that the banks they're tightening their belts and they're being really careful right now. I really have a lot of hope in what Upstart's doing. One little thing that they mentioned in their presentation is they start to give a little bit of data about things like looking at demographics and the fact that they do originate more loans to minorities, right? As an example of evidence that, hey, our process, our risk identification process is better, right? I'm hopeful that that's the truth, but we're not. Now, this is when we're going to start finding out.
Yeah, that's a lot of questions ahead. So thanks for that recap. I just don't know. I put this one in the too hard bucket. I'm going to keep watching it. I'm going to keep listening to people like you talking about it because I think it is a really interesting space, but I'm just not smart enough or confident enough to know that this is going to be one that's going to go crazy over the next few years, because it does seem like you are playing a risk reward game. $1.5 billion market cap. They've got to hit a home run to survive this. So any final thoughts there before we move on?
Yeah, there's nothing wrong with waiting sometimes. Just wait and watch and let the market. And here's the bottom line with Upstart, right? You don't have to get a perfect price on it. If it does have a revolutionary disruptive product and you wait and buy 2 years from now when it has data to back that up, this can still be a massive winner for investors. You don't have to buy at the height of the risk, which could be right now.
Yeah, you don't have to hit the bottom. You can wait until they've proven out that they can be a profitable business and wait till the risk part of the risk reward balance is lower.
Yeah.
All right, let's move on to Disney. They just released earnings, revenue up 9%. Let me just share the basic numbers here. I won't skip around the presentation too much because there's a lot of words here. Revenue up 9%, income from continuing operations before taxes up 30% to $376 million. Earnings per share 30 cents, so down 19% from a year ago, and free cash flow down 10% to $1.4 billion. there are a lot of pieces to talk about with Disney. So I want to just go through a few of those as I pull up the media and entertainment business. Revenue is down 3%. I'll cover a little bit of that. The linear TV segment is on the decline. That shouldn't be a huge surprise to anybody, but I think it is pretty notable. Disney Parks experiences and products up 36%. So here's where you're seeing continued strength in the parks and physically going out and doing stuff. I think this is, to me, the theme of 2022 is the companies that are making experiences that people can go out and do. Las Vegas casinos, theme parks, airlines, hotels. Those are businesses that have done just shockingly well this year when you consider where we were at a year or 2 years ago. So I
Travis,
think
Bank
that
of America and their earnings release at the beginning of earnings season a few weeks ago, they had a slide that showed like some spending trends, and by far the bucket of the areas that they showed with things like food and fuel and um, travel and entertainment was one. Not just the dollar amount, like the percentage of spend, but the number of transactions was in those experiential kind of things. So that's right in Disney's sweet spot right now. Sweet spot with that parks experiences business, because they're flexing pricing power right now too, right?
absolutely, absolutely. And then to go to the media and entertainment side of the business, segment operating income was down 91% from 947 million to 83 million. But here's the way to think about that. Linear TV is down, and they're trying to grab as many customers as they can in streaming, because once you have scale in streaming, now you can start raising your prices and increasing margins. What did Disney announce just a few weeks ago? They're increasing their prices to $11 a month for the basic plan without ads, and then there will be an ad tier for $8 a month. So this streaming service that was a steal at what was it, $5 a month when it launched just before the pandemic, is now going to be more than twice that price. I think this is the part that has been sort of difficult to watch as an investor, because the playbook is pretty simple. We're gonna grow this user base as much as we can, and then we're gonna slowly ratchet up prices over time. But you're gonna lose money in the process, or you're gonna not make as much money as you were making in the past in the process. So investors are gonna have to be patient with that. This seems to be playing out, but it's still gonna take more time, and we may not see that margin hit until a year, 2 years from now. And we've seen companies like Netflix and Peacock, companies like that are having trouble adding customers at the rate that they once expected. At least they have in the last couple of quarters, and some of them don't have pricing power at all. Disney, I think, has both, so that's a good spot to be in.
Yeah, Travis, I think one of the things about Disney to me that's, when you compare it to say Netflix and even Amazon to some degree, and some of those platforms that, like for example, Amazon and Netflix started as streaming, right? Well, Netflix didn't start, but you know what I mean. Like as it exists today, it's a pure
Yep.
play streamer. The Amazon has acquired some original content, right? It's bought a pretty big library and it's investing in original content. And Netflix has invested a ton in original content. Disney is the one legacy content owner that's going through this transition where the bulk of its operating income in that segment, like you said, is was coming from linear TV, and now it's building the platforms, those over the top platforms. And the sports one is going to take long time. I think we should mention
A really long
ESPN,
time. Yeah.
because
Yep.
it's going to take a long time, and to a certain extent, like with that, it's going through this zero sum period where it still has a lot of contracts and it gets a lot of its cash flow from cable providers, right? Um, it's slowly trying to detach away from that. So there's going to be this zero sum period, even with ESPN, until those contracts start to expire, and it can start scaling up the ESPN streaming products outside of people using their cable access, their login for their cable company to access ESPN and actually get like the NFL and Major League Baseball and those sorts of things. So I think that's an important thing to remember about it, is it's not just a land grab for Disney Plus and a land grab for Hulu. It absolutely is, right? But it's also this transition for ESPN. What I really wanted to say about it, Travis, is just like with the theme parks business, Disney has just the amount of intellectual property that's relatively timeless that it
Yes,
has is a
that's the
massive
key.
differentiator. People talk about Netflix having great IP. When's the last time anybody talked about Orange is the New Black?
Right.
Right? The
Or bought
it
a Orange is the New Black toy, or went to a theme park that
right.
had
That's
yeah.
the thing. You think about the Pixar, those toys, right? Cars, those things are timeless, and they're going to get rebooted over time. You think about all of the Marvel stuff, right? Same
Yep.
thing. These are relatively timeless. And the reality is that for so many of the things that are being developed by these other streaming partners, is they're interesting, and they become like, they have their pop culture moments, but they're not particularly timeless in the way that so much of Disney's IP is. And that's a massive differentiator, and why I can't imagine ever not owning Disney.
That's yeah, I 100% agree, and I think that is, from a content perspective, the thing that investors really need to think about is what how would you depreciate a piece of content that Netflix is buying or creating, and how would you depreciate a piece of content that Disney is buying or creating? Because I think those two things are very different. Like you said, Disney is very good at monetizing what they have. They still are going to movie theaters, and then they have Disney Plus, and they've got linear TV. But the content that they're making is going to be something that, I mean, my kids are 2 and 5. They they're watching the same movies over and over and over. They're watching the movies that came out when I was relatively young. When the first Toy Story came out. So that's really the difference here, is this model works. I do want to pull up, because I think this shows exactly what we were talking about. Linear networks down 5%. So revenue is down 5%. But look at this. Just printing money, $1.7 billion in operating income. So from a cash flow perspective, that business is still doing really well. Direct to consumer, which includes streaming, growing only 8%. So not growing as much as it was over the last few months, but it's losing $1.5 billion. Now, just do some back of the napkin math, and the price increase that they're implementing over the next couple of months, they'll get closer to operating income break even just with that price increase. So I think that's a good position for them to be in. They may have to pull back some of that spending on streaming, because they can't burn money there forever. But this is the kind of company that I want to be in for the next 20 years, not for the next 2 years. So I don't particularly care, if they're losing $1 billion or 1.5. I just want to see that the momentum is going in the right direction. And I don't see another company that's better positioned in streaming today than Disney.
Yeah, it blows my mind a little bit. The Disney stock right now is cheaper than it was 3 years ago, right?
Yeah.
The other thing too is that, yeah, sure, if we do go into recession, and if it's as bad as it could be, that's going to be terrible for the theme parks business, right? It almost certainly is. But it's the kind of thing that can actually be a boost for all of its efforts for streaming, because they're low cost, and people are always looking for they're looking for a way to kind of get away from their troubles, right? And so, yeah, it's interesting.
All right. Final thoughts on Disney. I'll start with this. We're in a market where investors are oftentimes, I think, well, we had a conversation Upstart, right? They're burning cash. We need to ask questions about how long can you do that? We talked about Lyft yesterday. Same question. How long can they keep burning cash? Disney, it looks like the market's pretty disappointed by this result. The stock's down a little over 6% after hours, but they're still profitable. They're still generating free cash flow. They're still, I think, one of the best names in streaming. They're arguably the best name in media. If the stock drops, I think this is a great buying opportunity. Just set it and forget it.
I have nothing to add.
Thank you.
Well done.
Do you want to? Should we go over to Lemonade?
Yeah, we can. They just dropped their press release and their letter to shareholders. So before I pull it up, so what is Lemonade? So we talked about how Upstart is building this AI-driven model for originating loans to expand access to loans to credit in a more affordable way to more people who are left outside of the current credit process, the FICO kind of monolith. Lemonade is trying to do something similar with the insurance business in terms of using AI, and they have multiple AI tools, but they're using AI to drive down costs. They're also changing some things to try to reduce the frictions in the insurance business right now, because the current model for most insurers is you pay a premium, they take all of the premiums, and it's called float, and they invest it and make a small profit or a large profit depending on what they invested in on that float. And then you file claims. And when people file claims, most insurance companies, it's not in their best interest to pay claims quickly, because that's float that they no longer will have to invest, right? So insurance companies typically have very low customer service scores. Like net promoter scores are some of the lowest of any industry in the insurance industry. So what Lemonade's looking to do is to change other things, like using reinsurance for the bulk of its policies to detach itself from those claims, using AI tools to pay claims like potentially in seconds, right? Little things like that they're looking to be able to do, using AI on the back end to drive down cost, to reduce so many of the manual things that insurance companies typically have people doing today. Travis, here's the problem. Lemonade has not been a very good insurance company in terms of making money on the actual price that they get for the policy versus their operations versus claims, right? So they haven't been very good at generating underwriting profit. Let's take a look at the quarter. So this is exactly what they give us every single quarter. So in-force premium, right? So this is up 76%. We continue to see that good. They continue to write more policies every quarter, and they continue to grow their customer base every quarter, up 30%. This is the big one. This, again, up 76% for that in-force premium. The premium per customer is up 76%. When you grow your customers 30% and your average customer spends 35% more, that's where you get 76% growth in in-force premium. So again, you see, going back to the 2020 quarter, was less than $200 million. So it's well over tripled in 2 years, Travis. So that's a real positive. Here's where it's not positive. Okay. Gross loss ratio, 94%. Okay. That's not good, right? When here's their goal. Their goal is around 70% gross loss ratio, 70 to 75%, leaving a substantial amount of money left over that can pay for reinsurance, and that it has left over, and that can be, the profit, right? So
are we seeing a company like Lemonade not have the fundamentally lower costs than sort of the internet and SaaS business model would imply? Is that fundamentally what's going on here?
Say that first part again.
You would think that a company that doesn't have sales reps and infrastructure in the same way that like a State Farm would
right,
be
they're
able
not
to have lower
agents
costs.
Commission a big chunk, right? Right.
Yes. So do they just not have the lower costs that you would think with an internet-based business, or is there something else going on?
So really what it gets down to is their ability to underwrite insurance, right? When yes, they're growing. Yes, they're spending a lot of money. They're not sure if it's in this particular in the letter or not. I'm trying to get down to the bottom of it to see. So their operating expense increased from $82 million to $110 million in the quarter, right? To a certain extent, that's expected because they are. I mean, when you have 30% more customers, and you are going to spend more money. The fact that they just acquired Metro Mile, right? So they're looking to offer auto insurance, and I think that added like 48 or 49 states that they are licensed to have auto insurance in. You have to have experts and the right people to manage the regulatory regime of all of these states. So of course they need to be spending more money on operations for people for stuff like that, right? Until you get to a certain level of scale. So the challenge seems to be as they're adding that expense. But again, to me, it gets back to that gross loss ratio. It is when you say you need to be in the 70s and you've been consistently closer to the 90s for the better part of a year, you're apparently you're just not really good at charging the high enough premium. I'm sorry, that's what it sounds like to me, and that's what I continue to have a frustration with. The management has also said that of course they're going to say this, but you to a certain extent you have to take some things at face value. And management says in the prior earnings calls, the policies that we wrote in the current quarter, we expect will have loss ratios, profitability ratios in line with our long-term goals. Okay. So you say that at the beginning of the year,
and then it doesn't happen.
We're in the third quarter and we're not seeing it, right? These policies are for a year. So it's a little frustrating, I guess is what I'm saying, because so many things about their business model I admire deeply. The ability to go on their website and to get approval for a policy or not in minutes is fantastic. That's great. That's a great experience. Let's say you have a renter's policy and your laptop gets stolen. To go online and file a claim and get your money in like 2 minutes, that's bananas, right? That level of extreme customer service and a positive experience with an insurance company is amazing.
Yeah.
But if you're doing all of these things and you can't get any kind of a premium on the premium for that, it's just, I'm beginning to lose. I really am beginning to lose conviction in their ability to. I've given these guys the benefit of the doubt for over a year. I love what they're trying to do. You just got to be a good insurance company too.
Yeah, we've got about 15 minutes left. Final thoughts on Lemonade. Again, this is another one that I simply put in the too hard pile / the prove it to me pile. I agree.
Yeah.
I like what they're doing. I like the theory. I like taking, we started with physical insurance agents in little offices, and then we moved to Progressive and Geico and companies like that. And this is sort of the next leg of that, but you got to prove that you can actually make it work financially.
Yeah, that's exactly right. That's fair. And, again, kind of like with Upstart, another great idea, interesting technology, burning through tons of money because we haven't demonstrated our product is superior. I think it's kind of the same thing with Lemonade. If you can stomach the risk and you taking a small position, I can understand, but I could also understand. And my recommendation to most people would be let these guys prove it. Let them prove it. Right.
Yeah, I agree. Okay, we're going to go to Axon, but I want to hit Plug Power quick because there was a question in LinkedIn about Plug Power. So I just want to share, this is a company that Jason and I have both been following for quite a while. To just kind of give a baseline, I'm really interested in hydrogen. The problem that I've always had with Plug Power is they promise and then don't deliver. They raise money from investors. They dilute
great storytellers and incinerators of capital.
Yeah. So they keep burning money and burning money and burning money. And it's always the next thing. Oh, we're going to do this over here. We're going to do this over here. But the losses keep growing. Eventually you get to a market like this. And I think it's really dangerous because the cost of capital, so the cost of the next share of stock that you issue or the next debt issuance that you have gets more and more expensive and makes the business riskier and riskier. So what happened? Well, they grew revenue. I believe the number was over 30%, but we're at $188.6 million in revenue. I think they increased their guidance as well for the full year. So from the top line perspective, it's looking great. But look at this net loss, $170.8 million versus $106.7 million a year ago. So losses are growing. That is not what should be happening as a business like this is growing. We should see
And I'm
losses
guessing
coming.
they're going to say something, uh, supply chain, something inflation, right? Foreign
Exactly.
exchange, those are.
Here's the other number. A year ago, they had 200 or $2.5 billion in cash on the balance sheet. That is now down to $1.75 billion. I haven't gone through the numbers based on this report, but they have a lot of cash. There's no doubt about that. But you got to figure out a way to actually turn that into earnings. And they have never, and I'm talking about, we have been talking about this stock for almost 10 years at this point.
Scroll down
They-
a touch. Let me see the long-term liabilities. Is that, I don't think they've really done anything to. No, they haven't really done anything to substantially improve their book.
Yeah, this is another company that in the hydrogen space, I think we're both more intrigued from an investment perspective by Bloom Energy than by Plug Power. I know there are people that quibble with that because of from a technology perspective, but Bloom has more revenue. The company is worth less, so you're getting a better kind of sales to price ratio, and they're closer to making money, and those margins are improving. So it's at least on the right path. I can at least kind of squint and see a good future. Plug Power just keeps doing the same thing, just keeps burning money. I don't know. That's all I got to say.
It's kind of like a lot of the companies in the electric vehicle space. I think electric vehicles are going to be dominant. They're going to continue to disrupt internal combustion engines, especially for personal transportation. I think hydrogen is going to continue to proliferate and expand across a lot of applications. That doesn't necessarily mean there are a lot of investable ideas in it, right? So Plug Power says we are an investable idea in hydrogen because hydrogen is going to be big. I think hydrogen is going to be big, but I don't think that Plug Power, the company's never proven that they can generate a return on shareholder capital. Why would you trust them now? That's where I stand.
And if you want an example of, again, this may be a case where we're both, I think, believers in hydrogen long term. But if you want an example of why the tailwinds being behind you doesn't necessarily mean that it's a great investment, look at the entire solar industry.
Yeah,
I've been covering this for 12 years, following it for 15 years plus. I have thought I've had a great investment thesis, a profitable company, everything working in your favor. And then it turns out at the end of the day, it ended up being a commodity, and there are very few companies that have been able to be profitable over a long period of time. So this is a company that has never proven the ability to be profitable. Why would we think they would be one of the few that survives?
There you go.
All
You
right.
want to make money in hydrogen, and you want a relatively safe investment, go buy Linde. Just go buy Linde. There you go.
Yeah.
Okay.
Or even like a BEP or BEPC, Bloom Energy Renewables. They're buying the assets and operating them.
Brookfield Renewable. Yeah.
Brookfield. Sorry.
There you go.
All right, let's go to a company that I really like, Axon. I think
Don't you love it when a company beats earnings and then raises guidance? Don't you love that?
Is that what they did here?
Revenue up 34%. I'm pretty sure that was better than expectations. They raise guidance. Buddy.
Yeah. So let's see. Revenue 312 million, up 34%. This is every time I look at their earnings report, it's right in this range, right? It's like kind of low 30s. But do the math on how quickly you grow if you grow 30% a year, and you become a really big company really quickly. Gross margin improved 100 basis points. That's encouraging to 62%. Gross profit was up. And then here's the big thing here. This is not a company that you're going to value based on a price to earnings ratio. You're still in growth phase, but they are now profitable. So we're not and they've bounced around that profitable number over the last few years. So I wouldn't necessarily say that, they're always going to be profitable, but as long as that top line number is growing, at 30%, that's pretty good right there. I was going to go zero debt, $371 million in cash. Is that good, Jason?
That is good. That is good, especially when it's a company that's also cash flow positive.
Yeah. Sales tasers, always a surprisingly solid business. This is really where they started, was making tasers. Over 60% margin on hardware.
Well,
I mean,
that was the name for the company's first 15 years, Taser International.
yeah. Until software and sensors, which includes body cameras.
Right. Their
And
Axon body camera, right?
yeah, so and then
Hence
they've
the
got
change to the
cloud.
name
Cloud is
Axon.
the SaaS piece of the business. Software as a
Mhm.
service piece of the business. So what they do here is sensors and other you can think of that basically primarily as body cameras.
Right.
And then Axon Cloud is the services that go along with those body cameras. So a law enforcement agency will sign a deal for 5, sometimes even 10 years to
Mhm.
take that data that's coming off of your body camera and put it on the cloud so that it can now be shared with, um, uh, you know, people in the prosecutor's office or whatever, wherever that needs to go. So that's the business that over time you look at Axon and you say, hey, a 74% gross margin business, if that's growing like crazy, then this is doing really well. Well, look at this. Axon Cloud up 51% year over year, 17.2% quarter over quarter to $95.7 million and a gross margin of 74.1%. That's pretty good.
I kind of hate it when people do what I'm about to do, but I'm going to do it anyway. This is kind of their AWS, right?
By the way, they moved off of AWS.
That's right. It did live on AWS,
Yep.
but that's kind of that same thing for them. It's a highly scalable, very high margin. But I think customers it's going to be far stickier. It's going to be more like a CrowdStrike or something like that. That's just so critically important. So you think about for law enforcement, it drives down costs. It helps them keep police officers on the beat in the communities they police instead of filling out paperwork or waiting in court. It drives down court costs because when there's video evidence that something did occur or something did not occur, it tends to get resolved much faster, right? When instead of relying on personal accounts. So they save people's life, right? The company was founded because the founder and CEO, like a close friend, died as a result of gun violence. And so they started this business to save lives, right? And that's the mission. So
Mission driven business, and it's really easy to understand. I mean, this is I think underappreciated in the market, is a business that is so easy to understand that a CEO can put it on a few slides, and then that trickles down to every single one of the employees knows what their role is in that organization. Investors know what's going on. Salespeople know what's going on. They're just executing so well on what they do. The piece that I don't see any mention of it yet, although I haven't gone through the entire report, is if this is going to take the next leg up and continue the run that it's been on for the last 5 to 10 years, it's going to be because they're focusing now on consumer devices. So consumer tasers. And then I would be shocked if they don't eventually move into like home security type systems. I mean, they have the cloud infrastructure there, right? If I can literally tie into my local police department and say, hey, somebody broke into my house and here's the video, it happened 3 minutes ago. Like that is incredibly valuable. They're the one company that kind of has the infrastructure to be able to do that. Now, I don't know if they're going to be able to pull off.
Yeah.
That's a bigger lift than being a law enforcement focused company. Being a consumer company is very, very different. But they've got the products that they can kind of repackage. If you've seen the packaging of their consumer taser device, it looks a little bit more friendly is the wrong word, but more consumer friendly than a typical taser, and yet is
Not
distinctive
as
from a
aggressive, maybe the
gun.
best way to describe it.
So
Yeah.
that's the kind of device that, I don't have a weapon for protection, but that's the kind of thing that if I was ever going to, that would be appealing to me. So I
So
can see where that market could potentially go. I don't know if they're going to get there, but that's sort of the next, double of their potential market size. So
did you show the cash flows?
I did not. Let me get to that.
Let me do that real quick here. So again, $41 million in positive operating cash flow. A lot of the companies we tend to talk about this time of the quarter don't have positive cash flow. Free cash flow of $26 million. I'm just going to ignore this adjusted free cash flow, because what they do is they take, so free cash flow defined as operating cash flow minus capex and purchases of intangible assets. So I like that. That's a good description. But you can't just exclude campus investments, which means it's money you're spending on your no, I'm sorry. I'm not going to let that one fly. So we're just going to ignore that one and pretend it doesn't exist. But the point is, this is a free cash generating business, and they'll have an updated presentation out, and I encourage people to look at it, Travis, because it'll show that TAM that has like the consumer part, and on top of the law enforcement and the courts and the legal industry, and like all of these little pieces of the pie that they do. And the thing is, like you were talking about, not knowing if they can break into that consumer market and offset the sale of things like handguns. The thing is that their share of the addressable market that they're doing business with now, like the SaaS stuff and the sensors and the taser devices, it's such a small number against just those buckets where we know they can execute. They don't have to do that other stuff to be a great investment. I think that's really, really important.
Another number that I always look at from them, annual recurring revenue grew 40% to $403 million. But here's the big one. Future contracted revenue. Now, this is contracts with primarily local law enforcement agencies. Now, some bigger ones, state and national as well. $3.73 billion to be recognized over the next 10 years. This is a company that is signing contracts for as long as 10 years. So it's going to keep growing unless you think that we're going to stop using body cameras, or there's another company that's going to come in and make a better body camera, which, companies have tried. It's almost like its own mini monopoly.
Yeah, they're a trusted partner with law enforcement right now. They're leveraging that. Great business. I can't explain, Travis, why I still have not bought shares of this wonderful company. Probably because I get really aggravated when I look at their stock-based compensation. That's like the one thing that consistently drives me crazy.
Because they did, is it Mike Smith? Is that the CEO's name?
Yeah,
Founder and
right.
CEO.
Yep.
Yeah. Just a quick aside. He sold most of his shares back in the day, more than a decade ago. And when Elon Musk came out with the, hey, if I hit these massive growth targets, I want a $20 billion stock compensation plan. And so they did a Axon version of that not only Mike Smith got, but they also offered it to employees. So yeah, balance that is part of your investment thesis.
There you go.
All right. Final words of the day. What do you think? Kind of a mixed bag here.
Mixed bag. So you see, you see the two proven winners in terms of generating great results, powerful brands, powerful brand equity with their customers, and Axon Enterprise and in Disney continue to deliver the goods. The interesting thing is, I haven't looked at Axon, but it's maybe up. But I think Axon and Disney continue, they're viable right now. I think they're very viable right now. The other side of the coin, you look at Upstart, you look at Lemonade, they continue to struggle, and they haven't proven to be good at the thing that they're telling us they're going to be good at. To me, they're both very much in the prove it bucket, and I think investors would do well to just let them prove it. Just sit back and watch, give them a year, and see if they can start delivering the results that they promised. Travis, what about you?
Yeah, I agree. More and more of these companies that don't have positive cash flow, net income, whichever metric you're most focused on, and then can't flip that switch when times get tough, can you raise prices to get to positive cash flow? I mean, Disney's raising prices right now. That is a really good sign to me. So I like what they're doing. Axon's been one of my largest holdings for a really long time. And that will continue to be the case. So I really like what their business is doing. 10-year contracts, growing backlog, absolutely a lot to like. So winners keep winning. I think that's kind of my theme for the day here. Well, we will be back. I think we'll be back tomorrow again, right? We got another big slate of earnings reports. So
Let's do it again.
we will be here. We'll be up on Twitter, LinkedIn, and YouTube again. So follow us, and we'll try to tweet out that link from YouTube earlier in the day today, so you can find us. But thank you for